Saurabh Mukherjea is now with us. He's a market master of the day, founder at Marcellus. He's with us here in our studios. Saurabh, a pleasure that you could make it. Thanks very much.
Good to see you guys in your home territory.
How are you feeling about the market, Saurabh? Looking good?
I think, look, this is the best macro I've seen in the 15 years I've lived here, both in terms of growth and in terms of the interest rate outlook. I don't think the central bank has said anything at Jackson Hole, which alarmed me. We are close to the top of the rate hike cycle. Economy is in good shape. We're seeing foreign investor flows back in the market. Yes, we got a bunch of elections ahead of us, but going into elections with current account deficit sorted out, the interest rate outlook in a decent place, GDP growth in a decent place, I think this is the best market setup for a long, long time. And, you know, it's not as if the markets run away from us. I think YOY, the market's up 10%. So it's all set for a super foundation for an extended period of an extended upswing in the Indian market, and we're encouraging our clients to especially build positions in our small and mid-cap portfolios, little champs and rising giants. But even in the large-cap space, I think Sonia just mentioned, big names in HDFC Bank look extremely tasty to us.
You didn't start by saying this is India's decade?
I don't have quite a crystal ball that powerful, but a few years, the next few years bode pretty well.
Yeah, we have heard that so many times now that, you know, we thought you'll also be chiming in. But no, I mean, jokes apart, the action is in the mid-cap space, right? I mean, the Nifty is up 6% this year, but the mid-cap index is up 20% already. So do you think that there is a bit of euphoria, a little bit of, left-out feeling in the market, which is taking anything and everything up? And could that be a bit of a cautious sign?
So I'll tell you why people like us are getting excited about mid-caps. If you see the Nifty 50, there's a bunch of PSUs in it and a bunch of metals and mining names whose underlying earnings compounding is pretty weak. And with the war in Russia, Ukraine having sort of peaked, and China on a deflationary trend, it looks to many of us that the Nifty there'll be a bunch of companies exiting the Nifty, and the entrants are likely to be high quality mid-cap names. And that's what's, I think, leading people like us to say, let's look at, say, some of our mid-cap holdings, names like Cholamandalam, ICICI Lombard. These sorts of companies look to me to have a far better structural tailwind than, say, oil marketing companies or metals and mining companies, who I think had a great 2022, but I think the best is behind them, and hence they're interested in mid-caps.
Hi, Saurabh. Good morning.
Hi,
Metals and mining may be a bit of a dizzy, but you're playing the refractory space, right? I think so. RHI, Magnesita, they've done a couple of big acquisitions. Last quarter's numbers weren't that great, but you believe that the outlook from here on is good? Are you a buyer at current levels?
So we built a position on the basis of three things, Nigel. Firstly, we see the sort of dominance RHI has in the refractory space. This is very similar to a GMM pfaudler position built out 4 or 5 years ago. You're looking for a player who dominates a critical space. So a steel company struggles to make free cash flows in the long run, but RHI is a critical ancillary supplier for the furnace of the steel company, 40% market share, 35% ROCs, and that's the sort of first foundation of the position. Secondly, GDP growth 7-8%, I think, for India over the next decade should be doable. Typically, steel output grows at broadly the same rate as GDP growth, and hence that's the second impetus here. The steel sector will grow. I'm not sure steel companies will make a lot of free cash flow, but the sector will grow. RHI should benefit from that. And the third piece is consolidation in that space. So RHI bought Dalmia's business last year. The smaller refractories are sort of folding up. I think it sort of boosted RHI's top line by around 33%. They had an exceptionally good last year. I don't think this year will be as good as last year. But if I take a 4 or 5 year view, a business which is dominating its space with 40% share, strong ROCs, strong cash flows, the ability to consolidate the smaller players, it gives us fair bit of visibility that this is a good small cap for our Little Champs portfolio.
We actually spoke with the Tega Industries, right? I mean,
they have the mill liners.
So it just kind of reminds me of that kind of a business.
That's a good company as well. We don't own that, but I think Mohan has built a good company.
It feeds into the steel.
That's right. So the ancillary, always look for the choke point. Look for the players in a commodity industry like steel. Look for the choke point. Look for the players who are hard to replace, where there are substitutes few and far between. Tega would be a similar sort of company.
What about GMM pfaudler, Saurabh? I mean, that large overhanger, that sale is gone.
Absolutely.
Is it, looking set for a turn?
So if you look at GMM for the last, I think, 5 years, Prashant, profit compounding has been around the 40-50% mark, right? The shares haven't done much for the last couple of years, courtesy the overhang of the German private equity player. You're right, with Chris Capital having acquired that position, I think the future bodes well. our reading of the situation is there continues to be a shortage of APIs, specialty chemicals related to pharmaceuticals. GMM is the global leader in that space in supplying ceramic reactors, glass-lined reactors to that space. So the earnings outlook is good. With the overhang gone, I'm optimistic that we'll make money here. Just a quick disclaimer, in all of these stocks, I hold positions through our PMS, so do my parents, and so do our 10,000 clients.
Obviously, okay. We got that. In your Little Champs portfolio, you also had Metropolis, and that one has been under a lot of pressure. I mean, the entire industry is going through some sort of weakness. Metropolis margins had been in multi-quarter lows. You continue to keep the faith here?
Right. So we have Dr. Lal in our large cap portfolio. We doubled that position in the summer of last year. In our Little Champs portfolio, we have Vijaya Diagnostics and Metropolis. The reason for building these positions was we thought last year the market got it wrong in terms of this sort of notion that there is disruption in the path lab space. I think the private equity and VC-driven players are by and large gone. The money has run out. We don't see the challengers being particularly credible. And therefore, Dr. Lal in North and East, Metropolis in Western India, and Vijaya Diagnostics down South, we reckon are the best placed players. Volume growth is revenue growth ex-COVID. Ex-COVID revenue growth is largely recovering to the levels it was at, let's say, in 2019, Sonia. Margins, we reckon, will recover. Pricing power is coming back to the leaders. It's a $10 billion industry. Barely $2 billion is in the hands of the organized players. So massive scope for formalization. So stay calm and continue building that Metropolis.
But in the management's own admission, right, whether it's Vijaya Diagnostics, whether it's Metropolis, they've spoken about how this B2B segment is seeing a lot of competition, especially in specialized tests. Then there is the wellness business, which is seeing a lot of competition as well. So, I mean, I understand that you continue to keep the faith here, but for an average investor, the losses have been quite steep.
So if you look at the share price action, Dr. Lal halved in the first 5 months of 2022. Since then, it's not gone down. In fact, it's gone, I think, around 10-15% up. Secondly, operating margins for these players are higher today than they were before COVID. Obviously, during COVID, the operating margins went through the roof, courtesy RT-PCR. But if you strip out the COVID years, operating margins today are higher than they were before COVID. And thirdly, all three of these companies are generating cash flow, right? So the thesis last year for a lot of bears on this space was there is disruption. Our view was it's rare to see disruption if margins are going up and cash flows are strong, and you're seeing the weaker players exit the industry. So COVID in a way was bad news for the incumbents because it brought a lot of private equity money into the space, and it brought sort of weaker players. It gave the weaker players a chance to compete with the stronger players. With the tailwinds of COVID gone, I think the place consolidates again around 3 or 4 leaders, and it makes sense for us to therefore build those positions when the share prices are weak.
All right, Saurabh, final question before we let you go. Just going to ask my director to pull up the HDFC Bank stock year to date as well as the Nifty. It's been an underperformer by more than 10% odd. We started this conversation where you briefly mentioned about HDFC Bank. Do you think it's getting into that zone, what ITC was, say, a few years ago? Rank underperformer, well-run company, valuations in favor, but the stock doesn't move. And now it's more important for Nifty because it's the largest component
There's
out
a
there.
big difference, though. If you look at ITC in the difficult years, their reinvestment in the business had tailed off, and as a result, earnings growth had moderated. In HDFC Bank's case, it's been the opposite. Since Shashi Jagdishan took charge, these guys have gained market share both sides of the balance sheet at around 20-21% growth a year. So 7% market share 5 years ago to 12% now. In effect, they've added a bank the size of Kotak Bank in 5 years. Secondly, the main reason I reckon the market is not sort of being able to wrap its head around is the sheer scale of what's being built here. The HDFC Limited acquisition basically makes this company the most profitable company in the country by some distance, right? And our country simply hasn't seen a company generating 11-12% of the nation's profits. There is a big ask here. Shashi and team will have to build 1,500 branches a year for the next couple of years at least to fund the HDFC liability franchise. Our reckoning is they'll pull this off. They did it last year, 1,500 branches. I reckon they'll pull this off. In the first 3 months of the current calendar, they pulled in CASA, which was equal to a quarter of the nation's CASA. So some of the numbers these guys are pulling off are phenomenal, and I think the sheer scale of what's happening here is befuddling the market. We remain confident. I think it's around 10% of our flagship portfolio. And our reckoning is this is probably as good an entry point people will get into the leading bank in the country. Probably the price to book, this is the cheapest it's been for 20 years.
Anything new you've added in the financial space? I mean, there are lots of these high growth housing finance companies.
So we've had Aavas and Home First for a couple of years. Aavas, there was a CEO change at the top, so Sheila Agarwalji stepped away. Shachinder, who came from Kotak, who built the Kotak housing finance business, is doing a great job. So we remain confident that Aavas will do well. I don't think we'll be adding plenty of new names in financials. If we see further weakness in some of the better run housing finance companies or say HDFC Bank, we might load up further. Prudent Corporate is the only name we've added this year. I think early months of this year, we added Prudent Corporate, which is a mutual fund distributor.
Just one, final question. In your Little Champs portfolio, you also have V-Mart Retail, and that one has been, if you just pull up the chart, I think it's lost 30% in the last 12 months. And, even if you look at the numbers, right, the losses are just widening for the company. So what do you do at a time like this? So
in V-Mart's case, I think the challenge is threefold. I think Reliance Trends has opened 2,200 stores, I think, in the last 4 years. Secondly, online, right, Meesho and Myntra have been very effective through the COVID years. And thirdly, Northern India, which is the heartland of the V-Mart business, the Hindi-speaking towns of Northern India, there's generally a downturn in blue-collar workers' revenues. The management team is aware of the challenges. They're trying their best to turn things around. Our reckoning was the quarter that went by. Although earnings were negative, on a cash flow basis, 1Q of this year was probably the best quarter for a couple of years. So in V-Mart's case, Lalit Agarwal and team, they're trying their best to turn things around. But it is I agree with you, Sonia, it's a steep hill for them to climb because you've got Reliance's muscle. You got the Meesho, Myntra, because the online is turning out to be very effective in the Hindi-speaking towns.
Tatas are getting into low-cost fashion in a very large way. I mean, they're doing, and I think Reliance has introduced a new brand in that particular segment, which they plan to expand. I mean, so yeah.
So look, I mean, Zudio is doing brilliantly for Trent, but I think thankfully for V-Mart, Zudio isn't yet the biggest challenger. I think it's Reliance Trends, which is the biggest challenge in the Hindi belt.
Okay, Saurabh, appreciate your time here. Thanks a lot for joining in as always. And thanks for coming to the studio. Hope to see you more often.
Great to be here.
Thank you.
Just one more, Sonia.